really good leverage and taking a lot of risk and betting on you as an owner operator to do the right thing and be successful. And we don't take that lightly. So we're going to do all we can and put all the effort that we can into underwriting, making sure you've got the right referral channels, making sure you're set up the right way, making sure you have the right general contractor, making sure you have the right administrator, the right mix of things that are going to make you successful.
Welcome to the RAL Room Assisted Living Podcast with your hosts, Charlie Cameron and Alex Schlow. This is your go-to show for cutting-edge insights from industry leaders in residential assisted living.
Whether you're ready to launch your own assisted living business or looking to invest in this fast-growing, high-impact sector, we are here to equip you with the tools, strategies, and confidence you need to succeed. Get ready to ride the silver tsunami and change the future of senior care. Now on to today's show.
All right, welcome back to today's episode of the RAL Room Assisted Living Podcast. I'm your host, Charlie Cameron. And today we're thrilled to have Mackey Hughes from Live Oak Bank joining us. What's up, Mackey?
Hey, how you doing?
Good, dude. Good. You've been on our mastermind quite a few times, and I think it's finally time that we had you on the podcast. We've not had an SBA lender on the podcast, so I think this is going to be hugely valuable to listeners. We're going to get into the nitty gritty today, and it's going to be awesome. I think we should just get right into it.
All right.
Mackey, tell us a little bit about your background as a loan officer for Live Oak and how you came to focus specifically on senior housing and assisted living.
Sure. Yeah. So originally, my background is in legal. So I'm an attorney, and I was doing attorney things in the courthouse, and then I fell into banking as a closing attorney. And what I did for M&T Bank was I was focused on agency lending and closing in that world. So that would be Fannie Mae, Freddie Mac, and then some HUD stuff, right? And so that's basically multifamily, senior housing, stuff like that. So I fell into that, moved over onto the underwriting sales side and stuck with that industry. And then about almost 10 years ago, came down to Live Oak Bank, and we formed the senior housing group here about 7 years ago. And then a lot of that was based around owner operator assisted living. And that really was a great platform for the sort of the SBA product, where Live Oak made it their bread and butter for keeping things going, keeping things efficient, and really becoming a quick sort of process compared to other SBA lenders. And then we grew the bank to where we became, in the last few years, one of the largest, if not the largest, SBA 7A lender by volume over Wells Fargo. And then we've got a couple other players in the market, but we do a ton of that. We're one of the few banks that really focus on the owner operator assisted living side of things. And we do memory care, a little bit of skilled nursing, but that's how it all came together. We've had a really good run. Portfolio's done really well. And obviously has a big need in the market for this type of stuff. And so we're excited about it. And we're just going to keep pedal to the metal on this stuff. We're excited.
I love that. High performance from assisted living. Is that what drew you to it? What was the reason for starting that team, and why is Live Oak so into assisted living?
We look at this as an operating business, not a real estate play. So we are very, and not just in senior housing, which is what I focus on, but in every business at Live Oak, we focus on the operator. And what we say, who has the eye of the tiger, who cares about people? If you do the right thing, you run your business the right way, money will come. But we really do it because of what services we're providing for everyone's loved ones. And it is a culture thing, right, for us. It's not something that we're looking at as, hey, we're going to make a lot of money. This is something that we care about. We get the right people that care about it on our team. And it's really that mentality that you have to have if you're in the business of taking care of people. And so that is something that appealed to me and all of our team. And so we get to go out all throughout the country and see all the great things people are doing. It's very rewarding from a personal perspective. And so that's something that's great, right? I could do gas stations and dry cleaners all day, but this is more rewarding to me than that, right?
Yeah, for sure. And you get to go to the homes?
We go and see every single person that we lend to and shake their hand and look them in the eye.
Wow.
That's part of what we do. And we get people that we'll go and see somebody in the middle of nowhere, Idaho, and they have a bank across the street and the guy never came to see the business or anything. So we just do that. It's part of our credit culture. Really, we don't want to lend to somebody that's not in it for the right reasons. This is something that matters a lot. And so that's part of our credit box, credit culture. We don't even get deals through underwriting until we go and see them. So we're out and about doing all that. So it's unique, but it's the right thing to do.
That's awesome. That's awesome. I love that. And we talk about it on the podcast quite a bit. People approach relationships with lenders in such a strange way. They look at it as, I'm going to get the best deal and I'm going to find a bunch of them. And then they get upset with terms and this, that, and the other. I'm like, you got to understand, you need to build a relationship with a lender that is there for the long term, because you continue to help each other. They're part of your team. This is part of your team that you're going to go out and establish a home with. And so you got to treat everybody, your employees, the real estate agent, and the title folks, and the construction company, and the lender like partners in the deal, because ultimately you're probably the closest partner for the longest amount of time post-close, right?
Yeah, whoever your lender is, and hopefully we can be involved with and earn people's business. But at the end of the day, that's who's taking the most risk, right? The bank. And we lend money like we're lending our own money. We are publicly traded, but we are still a small bank. And the mentality is, hey, if the deal goes bad, that's on us. We're taking that hit. We don't really have a lot of deals that go bad, but I think people understanding that, hey, look, if I'm fighting over a down payment or whatever, we're still given really good leverage and taking a lot of risk and betting on you as an owner operator to do the right thing and be successful. And we don't take that lightly. So we're going to do all we can and put all the effort that we can into underwriting, making sure you've got the right referral channels, making sure you're set up the right way, making sure you have the right general contractor, making sure you have the right administrator, the right mix of things that are going to make you successful. And it's a lot of work to do that. And so when a lot of times now people think, oh, well, I'll just go on a website and click a couple buttons and then I'll get a business loan like that. Okay, yeah, maybe you could do that, but are they really thinking about you as an owner operator? Are they thinking about the success that you're going to have? Maybe not. We do that. We are going to dig in and we're going to make sure that we're putting you in the bank in the right position to succeed.
Of that. So what makes SBA loans uniquely suited for assisted living projects, especially the smaller residential style?
Yeah, so basically it's leverage, right? So if you think about the way the capital markets are in the senior housing world right now, if you're going to do the big box world, which is historically what this is, right now you're maybe going to get 60% leverage, maybe less, which means, hey, I got to come up with 40% down. That's not going to happen for the regular guy. Okay. Yeah. And that's what is the big barrier to entry to do these kind of conventional deals. Whereas SBA, thank God, allows you to lever the deals up to where somebody that's a regular guy or a regular girl can come in and start their business or buy a business that's operating. And hey, I can actually get there. I can put a 10% payment down, or I can get a seller note to help me with that or whatever. So basically it's access to be able to live the American dream, right? You have your own business. You're going to make generational wealth for your kids. And that's what the whole program's about. So really, it's just about getting people in the right position to be successful and opening that up to the everyday guy.
Love that. Yeah, SBA makes it a lot more accessible for first timers and newbies. And I think that's the point of SBA in general, right? To allow people to start businesses from the ground up, their first or second one.
Yeah. And it's important. It's really the lifeblood of the economy in the United States is small business. Okay. That's really where the program shines, right? Because it's been around for half a century, right? So that or other programs that help people get where they need to be and protect that owner operator from more institutional borrowers and more people that have a lot of backing or companies that have a lot of backing. So that's what's great about SBA. And then they're very favorable performance terms, right? There are no performance covenants as long as you're making the payments, you're not in default. There are no balloons. And so it just protects that part of our economy, which is the biggest part of the U.S. economy, essentially.
Yeah. Okay. This one, I think, is one that will help clarify for the listener. So there's kind of two ways to go about the terms on SBA loan for assisted living. One is if you're just purchasing the business, then you're looking at a 10-year term. And if you're purchasing the business and real estate, it can be as lengthy as 25 years. Can you explain that in more detail?
Yes. Yeah. So if we're doing just a goodwill intangible loan, you're able to go to 10 years and then fully amortize 10 years with no balloon payments. And so that would be like, hey, I just want to buy the operations, or I want to buy a home care company, or I want to buy a book of business and investment advisory, or whatever it is. Because there's no real estate involved with it, that's your 10-year shorter term loan. Now, if we put real estate in there and the majority of the proceeds of the loan go towards real estate, now we can stretch that out to 25. And even if you're doing a startup ground up construction, it's actually 26 years. And so it's just a matter of between having real estate or not. And those are the two options that you have with a 7A.
And what are the differences when it comes to buying an existing home versus a ground up development for SBA?
Okay, so existing home, I'm assuming we're talking about an existing care home or facility, small facility. The difference is, hey, there's probably in place cash flow there. Okay, you're walking into something that is already operating. We look at the seller's performance and we look at, all right, does this cash flow, whatever debt amount we're going to put on it, and does it make sense for the purchase price on that building? And so we'll look at the last 3 years of tax returns, year-to-date P&L, and then payer sources. Most of this stuff that we're talking about now is all private pay. So a pretty simple thing, like, all right, this is making this amount. You're doing this amount year over year. We look at those trends. We feel comfortable with it. We give the loan. So that's acquisition. That's probably the easiest financing we can look at. Now, the other side of this is, which is a lot of what we do in this world, because it's a newer segment of the market relative to the old school way of looking at senior housing, is startups, right? So we're either looking at ground up construction, we're looking at fit of maybe existing structure or whatever that may be. And that's going to be a little bit more of legwork, right? Because we're looking at it from a pro forma basis, or AKA projection style deal, right? We're going to be like, all right, what are your month-to-month projections for 3 years after you build this thing? How fast is it going to get there? How do we structure financing around it? Where are you going to source your residents? Are you in the market? What's your experience? And we dig a little bit deeper than if you walked into a business that was already making money and you just take over and keep things going.
Okay, that's awesome. Yeah, thanks for the explanation, because I know we have folks in our mastermind doing both. So it's really cool to see that SBA can even back a ground up development, which is what we're working on as well. So what in general does a borrower need to have in place to get approved for SBA financing for assisted living?
Sure. I always get a question like this. What do we need to have? What's our DTI and all this kind of stuff? What's great about, the way we look at it, the way we underwrite, and the way the program allows us to be flexible is it's like case by case, right? We're going to have to feel really good about the deal. You have to have a reasonable ask. So basically the whole idea is we're not going to put a bunch of debt on somebody or a business that can't handle it. We got to feel good about how we're lending the money and making prudent decisions on structuring a financing package for your specific deal. So we're tailoring every single deal to the particular location, market, and borrower. And look, you don't have to have, in our minds, as long as you have a reasonable business plan and you feel good about it, have a good background, whether that's a business acumen or caregiving or whatever, to make it make sense, right? It's not a plug and play. It's just, we literally go into everyone's resume. We say, hey, all right, this makes sense. People have a little bit of liquidity saved up. They got a little bit of things go a little bit lagged, or things come up, or we have a construction increase. We build all that in, but essentially good credit score, a decent enough background, or even just showing in a really good business plan, hey, this is my idea, and just being responsible with your personal finances or other businesses that you may have owned, or even just having a background that shows consistent income. All of those things we'll look at and say, hey, this person's the right fit. They really want to do this. And they've been responsible, like I said earlier, with sort of their liabilities throughout the last 10 years. And we just build from there. It's great because you can say, hey, look, we've got somebody that maybe maybe they owned a self-storage, or they owned a hotel and they were successful with that. And they show that and they say, hey, I want to get into this business. And you can say, hey, look, they've already been successful there. That's pretty easy. It's a small business loan, and just showing some sort of acumen there, and then also having the care component that we touched on earlier is important. But it's great to be flexible with what we can do. But we also, again, just having a really good business plan and feeling good about the deal is really where we shine a little bit, right? We're open to a lot of different backgrounds. This business is hard. It's hard to retain caregivers. You're dealing with people's loved ones, and there's a lot of emotion there. For the most part, once you can get a hang of it, once you get going, it's a business that I think people obviously in your world are interested in. It's not rocket science. It's just taking care of people. And as long as you do that, to put that first, it's probably going to work.
You're bound to succeed. Yeah. If you put care first. Shocking, right?
Yeah. Customer service care.
Yeah.
It's all the stuff. And it sometimes gets sappy, but that's really what matters.
Yeah. I just started listening to, what is it called? It's like Exceptional Service. I forget what the name of the book is. Unreasonable Hospitality.
Yeah.
And that, I think everybody who's interested in assisted living needs to listen/read to that one, because if you implement everything in there, you're not going to have any issues staying full or retaining staff, because it's about unreasonable hospitality for the folks that work for you. And then they push that onto everyone else, the families, the residents, which is pretty cool to see.
Yeah. And involvement, right? We want you to be there. We maybe not there every day, but you're there. You're talking to the adult children. You're caring for your residents. You're setting the culture of your facility to a degree of going the extra mile for everybody. And then what's great about these smaller facilities is you actually get to know everybody. The caregiver gets to know everybody. There's not one caregiver for a floor of 30 or 50 people. And I think that's beneficial with this model. Caregivers like this model because they actually can do their job and get to know the families, understand the challenges for each resident, right? People are moving on to the higher acuity, and hey, little things like, hey, maybe they want this certain sandwich, or they want this certain view, or they like to do this during the day. And then catering to that goes a hell of a long way. And then communicating that and to the adult child is those little tiny things like.
Sorry to interrupt this episode, but let's be honest. Most real estate investing right now, it's either buy a fourplex or try Airbnb and hope for the best.
Yeah, we're not here for that.
We're here to show you what we believe is the most overlooked high cash flow real estate strategy in the game right now. You guessed it, residential assisted living. It's literally the one place in real estate where you can net six figures on a single home and feel like a decent human being at the same time. You're helping sweet old ladies eat pancakes and play bingo and live longer through better care. You tell me what's better than that.
So we're hosting a free live webinar called How You Can Create Financial Freedom with Residential Assisted Living. No fluff, just value. And it's happening at 8:30 p.m. Eastern Time, 6:30 Mountain Time. No excuses. It's online. Put on sweatpants. We won't judge.
We'll break down why residential assisted living is the best opportunity right now, the 5 steps to take down your first home, and how to set up a business that makes a real impact and real money.
Spots are limited, so don't be that person who DMs us in 3 months saying, wait, is it too late to start?
So hit up theralroom.com/webinar and register now.
Be the hero your grandma already thinks that you are.
We'll see you there. Pancakes not included.
You go a very long way. And so we like people to be involved. We don't really like remote ownership. It's just if you put your loved one in a care home or whatever, you want to know who owns it. You want to know that they're the right kind of person, and then they're going to look after somebody, right? So it's basic stuff, but just the little things that's really what takes the regular to the next level of being exceptional owners.
Yeah. Okay. So what I'm hearing is each person is evaluated independently. And some of the things that are going to help is having a great business plan, is having that caring personality, the person that wants to get involved, being local helps, having some sort of business experience can help, having shown long-term income ability helps. Is there anything else that someone that's brand new to the business should have in terms of experience or a support team to be taken seriously for a deal like this?
Yeah, I would say involving you're going to have a team to make this work, right? So when you're talking about putting together a business plan and having maybe some folks that they're maybe not on the loan, maybe they're employees, and then highlighting maybe their background and how they're going to help the business is also great. And the business plan is so important. You'll go to different consulting firms or whatever, and they'll put together some sort of boilerplate business plan, which is great, right? That's great. that's a great start. But like tailoring that business plan, even just a couple pages, and it goes a long way for our underwriting to get to know the person, to understand how their business, that particular location, is going to perform. That is invaluable to what we look at. And so we'll push people a little bit further to get those answers, and we'll help with that. That's what we're here to do, because we really want to know that we're investing basically in success, and we want to feel comfortable with our partners.
Love that. What are some big misconceptions people have about SBA loans?
The length of time that it takes would be the first one. And the other misconception would be outside collateral, all this other stuff. To make it very simple, SBA has a rule, like a rule book, basically, of like how to lend. It's called an SOP. And just because but every bank can really be more conservative or less conservative within those parameters, right? So it's like maybe you have a rule where, hey, if the SBA is okay for, let's talk about collateral, right? So if you have a facility that appraises to cover the loan, you don't have to take additional collateral. Now, a bank might say, no, we're going to take additional collateral above and beyond what the rules say. We try not to do that. So we're a little bit more flexible with the rules in our credit box. So, and then the other thing is timing, right? So you have regular lenders and you have preferred lenders. So preferred lenders like us and a good number of other banks that do this a lot, they'll do a whole thing in-house. So whether you're getting a regular commercial loan or an SBA loan, it'll still be the same timeline, right? So those are the two things, like being able to be flexible with what you actually can do, and then also doing it quickly. So those are the things, the misconceptions that I've seen over the past 10 years doing it.
That's great. If someone is about to, let's say, put a home under contract to purchase, what would you recommend in terms of timeline in order for financing?
Yeah, for us, the majority of it's going to be like a 90-day turnaround, which is that's really the biggest barrier to entry, because if you have a seller that's a residential seller, they're going to want a 30-day close. There are ways around that. We can refinance a sort of a hard money loan or even a residential loan that has a short term. If you're dealing with a seller that, is 30 days, that's it, or I'm going somewhere else. With raw land, that's a little bit less common, right? They're more flexible. Sellers generally, they get 90 days is fine and maybe extension. But that's really your biggest barrier to entry in this segment of senior housing.
Gotcha. Can you share a story of a successful project you financed recently and what made that work?
Yeah, we've closed more deals this year to date than we have ever closed. So there are so many success stories, which we're excited about sitting here mid-June. I would say some of the coolest deals that we've done have been with repeat customers. And I like to highlight that because maybe we got somebody that did their first one 2-3 years ago, and they've been successful. They've been great, and they come right back to us, and we're able to provide 100% financing on their next one. So nothing out of pocket. And they're like, that's awesome. Like, I don't have to come out of pocket, and I can expand my business. I already have a wait list. I have my one now, and I get to do a second one, and we just keep rolling on that. So we've had a lot of that success this year because we really just started doing this about 8 years ago. So you're starting to see that sort of snowball into success for our existing borrowers. And then we get the new stuff too. I think we've really ironed it down to a pretty quick process. We've got our credit folks really comfortable with this model, right? And it's relatively new, this whole segment of the market to senior housing, and we're just ahead of it. Us and just a couple other banks do it. We've had folks that have had home care companies that, hey, we want to get into facility-based sort of care. And we've done a lot of those lately. So those have been great. And then I would say getting folks maybe even out of the smaller bed counts into the next licensure and helping them expand into the bigger stuff while still providing the high level of care. So we've had a tremendous amount of success with reoccurring people and new people. And I think just right now, it's just a hot market. And I don't see that stopping in the next 20 to 30 years.
Wow. Yeah. 20 to 30 years. Because you look at the demographics and it's clear, right?
It's very clear. Yeah.
The NIC reports 26,000 new units a year coming online.
Easy. Yeah. And that's conservative.
And we're 1 million beds short. There's 1 million beds on the way. It's ridiculous how big the discrepancy is between demand and supply. that I think you're right. Like this may be your best year yet, and it's just getting started.
It's just getting started. We've expanded our team. We have a nationwide footprint. And like you said, we do go to all the NIC stuff. We got the NIC maps. We do all that fun stuff. And a lot of that NIC stuff is geared towards a more institutional side. But every year, I've been going to the NIC for 12 years, the middle market and then the smaller segment boutique stuff like this is just getting bigger and bigger. And you'll see people on panels that would not be invited to panels like maybe 6 years ago, but now they're recognizing this segment of the market and they're really taking it seriously. And so we're just happy to be on the forefront of that. And it used to be frowned upon because you weren't doing the big fancy schmancy deals, but for most of the country, they can't afford that. And so this is a huge opportunity for folks that want to do the right thing and help people. And also it's becoming more the norm than it used to be. It's not really this little frowned upon SBA type of deal. It's becoming more and more mainstream. So I like to see that. And it's fun to watch that shift in the market.
Yeah. And you're seeing more of like repeat models happening and the ways to do it and floor plans and things like that, which I think is cool. We're just getting started on what's going to be possible. And
yeah. And like Charlie, with this group and all the great things you're doing and like the mind sharing and all the stuff that people can learn from, that this is like grassroots stuff. It's pretty exciting. There are some small franchises. The challenges with the franchises in that model is every state's different, right? Every state is very segmented in how many beds you can have and all that kind of stuff. And we're very aware that we underwrite to it, but it's just, it's the sky's the limit, whether you're involved with different groups or whatnot. It can only help you to be listening to this and sharing with folks that have done it and folks that are getting into it. It's this phenomenon where it used to be, hey, there was only a certain amount of folks that in each state that owned all these things, and that all is going away. So it's exciting to see that shift, like I said earlier.
Yeah, I want to talk a little bit more about the future of financing, but before we do that, can you explain, this is a question we get a lot of, 7A versus 504. What is the difference in layman's terms?
Yeah. And it's kooky, right? All right. So 7A is probably the majority of what we'll do for this segment in the market. And the reason being is you can finance everything under the sun. So not just your real estate purchase and your construction, but also your working capital, right? So working capital kind of breaks down in 3 buckets, right? So you're going to have your interest reserves, which is basically the loan paying itself until you finish construction. And then you'll have interest reserves, which is loan paying itself as you lease up or ramp up. And then you'll have an operating deficit, which we'll also throw in there. So that all can be put into one loan on 25 years or 26 years with a 7A loan, right? 7A loans, you top off at most banks about $5 million in debt. We'll go a little bit higher, say $7.5 million-ish if we need to. But that's the simplest, easiest way to get it done. And really, at the end of the day, you're only putting down 10 to 20%, depending on just the deal itself and what pencils out. So that's 7A, very simple, everything in one loan. There's not construction to perm. There's only a 3-year prepayment penalty, 5%, 3%, 1%, and that starts the day of close. So it's a very good product for people getting started. And also, like I noted earlier, if you're doing expansions, you don't even have to put anything down. So that's 7A. That's the easiest path that gets everything done. But there is a little bit of a size limitation there. 504. So 504, you can only lend to the actual tangible asset, which means it has to go towards the real estate project. So you'll do, say, a construction loan, which you're only lending to 50% of the appraised value. And then the SBA holds another note behind you effectively after you open up. But that can only finance the real estate and everything associated with construction real estate. Once you're done, there's no additional working capital that you can put into that loan. So all the operating deficit, interest reserve, post-construction, all of that, we'd have to figure out another structure for outside of the actual 504 deal. And so that's going to be, we'll probably add another loan to do those other intangibles behind that, but you're minimum coming in at 20% of the tangible, and you have to borrow something extra. But you can do larger deals, right? So like you can do pretty much 15 million debt total. So so it's not as much suited to the smaller 6 to 16 bedders. That's more of a product that's going to be maybe 60 to 100 bed That's where we see it shake out. So you're putting in more money. And also with 504, it's not something you can do in-house as a preferred lender. So it's going to be a longer process. We actually have to take the deal and submit it to the SBA in Sacramento office, and they have to look at the deal and approve it. It's a longer process. Now, banks love you have a bank or credit union, whatever, they all love to send out a 504 term sheet. We love it too. We do plenty of 504. And the reason being is that the bank's going to be in a better position at the end of the day, right? They're only going to be 50% loan to value, where a 7A, they'll go up to say 85% loan to value, 90% leverage on loan to cost. So that's the difference, right? So 7A is your banger. Now, the only thing that 504 will help out with a little bit, even though you're going to have less leverage and a higher down payment, 504 will have a lower interest rate, but it also will have a longer prepayment penalty. It's just a matter of what you feel comfortable with, what your time frame looks like, and if you have a lot to put down. The bank's always going to want to push you to 504. We're okay with 7A. We are really comfortable in this market with it, but it's just a matter of what the situation commands and what people want. If they want the lower interest rate and they want to put more money in, 504 is great. If they want the leverage and they want to do everything in one loan and do it quick, 7A is the way to go.
Okay. That was a great last summary there and an awesome breakdown. Appreciate that, Mackey. With the silver tsunami upon us, how do you see lending evolving over the next 5 to 10 years, or do you see it staying stable?
We had, for the SBA world, even with the craziness of the last 5 years, we've been pretty steady with lending. It's a needs-based service in our minds at this bank. There have been a lot of banks that maybe have restrictions on how much they can lend to certain segments of the portfolio, right? So we've seen a lot of banks be on the sidelines because they have too much commercial real estate on the books. Maybe they have residential components, which we do not offer residential loans at Live Oak, but all of that is limiting a lot of lenders right now to jump in the game. And that's why you see upmarket, that sort of low risk structure that's common right now in the marketplace. I don't see that lasting. I think leverage will come up with a little bit than what it is, but there's really, in the small business world, there's really nothing stopping us. There really aren't very many headwinds. Interest rates have leveled off, and I don't see that changing, honestly. I don't see us doing deals at 4% like we could do 6 years ago. Yeah. And I don't see that in the future. I really think it's just going to be, it is what it is. And I think folks in the market have adjusted to that norm. You can't predict another pandemic. You can't predict all these other things. I've been in banking since 08 years and all that fun stuff, Dodd-Frank and everything. And I don't anticipate that. You never know what's going to happen, but it seems pretty steady Eddie on the SBA side. When things are a little bit tough in the market, like they are now, we're getting looks all the time that maybe we wouldn't have gotten. Maybe people that be more of a conventional lending sphere, they're looking for more leverage, right? So they're going to look at an SBA deal a little bit closer than they would in the past. We're just making hay while the sun shines, but I don't think that anything, barring any crazy stuff, is going to change much. I don't think interest rates are going to go down much in the next few years.
Okay. Any new products or structure changes that we should be aware of?
Yes, the SBA under the new administration has made some changes. Like you used to be able to do a little bit more leverage than you used to. They clamped down a little bit on maybe folks that have expired green cards. There's been differences in cash out. You can do some more cash out than you used to be with 504. But generally, I always underwrote the deals as they were. They reset the rules to what they were 3 or 4 years ago. They got a little bit flexible and then they went back. So nothing really that's going to change leverage all that much. But C-PACE, you can't do that anymore. And you can't, so they've really tailored it back to the owner operator, which it protects the program. We lost a few different deals over the past few months because of the rule changes, but all in all, we underwrite it the same as it used to be, right? We want to have some skin in the game for our borrowers, and it really hasn't changed that much. And even if we had those other flexible rules, we really didn't, at least on my team, we really didn't change all that much because we still want to do a good deal that makes sense for both the bank and the customer. And so in this part of the real estate side of things, it's really not made a huge difference, honestly.
Okay. Okay. So if someone listening right now is serious about launching a residential assisted living business, but they're worried about financing, what's the first thing they should do right now, today?
I think really the first thing you should do is reach out to us and we can have a conversation and say, hey, look, where do you want to do it? How much money do you need? What are your plans? And then we can look at we'll send them a form with a personal financial statement on the SBA form and sort of start from there. Okay, you want to do this is how much cash you have to put down. Maybe you have some investors. Maybe let's go ahead and get a business plan together, a pro forma, and we'll start structuring a deal, right? So we can just be like, hey, all right, you want to borrow $2 million. All right. How much is going to construction? How much is going to the purchase of the real estate? How much is going to working capital? And we should start like nailing it down. Hey, like, all right, if you want to do this is how much you need to put in. And then just start helping people kind of get some parameters and focus in on what leverage is available. And we do a lot of that on the front end. Now, half of that comes to fruition, half of it doesn't. But we're always here to help. We do this all day, every day. We got a great team. And I think that's where we start. Just go ahead and reach out to us and let's just start the conversation. It could be a year from now, it could be 2 years from now, but at least you have an idea of what's available for financing, whether it's with us or another lender. We're just happy to have the discussion and try to earn people's business.
Yeah, I can attest to the fact that you're super helpful in emails and calls, and we've had quite a few and hopefully quite a few more now that we're under contract on some land to develop ourselves.
Yeah, it's exciting. And look, it's a dynamic process, right? You're going to run into speed bumps along the way. We're just here to say, hey, look, this is the bottom line and let's see what we can do to make it work.
Love it. All right. So with that, Mackey, how can people get a hold of you to learn more about financing?
Yeah, I would say, so we've got like a website where we are one of the larger SBA shops in the country. I would suggest coming directly to us so you don't get stuck in the line of the website and filling stuff out. We do get a lot of web leads and some of them are misaligned. It's just filling out the little form on the website doesn't really get you straight to us. So I would come to us. If you share my email, it's mackey.hughes@liveoak.bank. Email me directly and we'll get our team working on everything. And it's just better to come straight to us rather than go through the website. If you want to start with that, and having this platform is great because we can communicate with your members here to do that. And we're really quick to respond. So we just, as a team, just like to go ahead and knock it out without having to deal with going through all the website stuff.
Love it. All right. So that's Mackey, Mackey.Hughes, Hughes @liveoak.bank.
Correct, Charlie.
Nailed it. All right. Mackey, this has been awesome, dude. Thank you so much. Really enjoyed this one, and our listeners are going to love it. And I hope to have you on again soon.
All right, Charlie. Appreciate it.
Thank you for tuning in to the RAL Room Assisted Living Podcast. We hope you found today's episode insightful. If you enjoyed it, make sure to leave us a raving 5-star review. And a quick review helps more listeners find the show and more seniors get the exceptional care they deserve.
And don't forget to subscribe so you never miss an episode. And just so you know, we have prepared some free resources for you to help you succeed in residential assisted living in addition to this podcast. Head over to theralroom.com, that is TheRAL room.com, to download our free 10-step guide to launch your first or next residential assisted living home, or our 10 reasons to passively invest in residential assisted living ebooks.
And if you're ready to take the next step and make real moves in the RAL industry, join us in the RAL Room Mastermind. It is an exclusive community where we deep dive into everything you need to launch and grow your own residential assisted living business. You'll get access to recorded courses, live calls with industry experts, a RAL calculator, resources and tools, like-minded entrepreneurs, funding opportunities, and an expert networking community to help you along your journey.
Be sure to join us next time on the RAL Room Podcast as we continue to explore the world of residential assisted living with more great guests. See you then.